Hello, my name is Hussein and I'm Forex Optimum Broker Financial Analyst. Markets are still slightly shocked after the Federal Reserve has changed its position towards earlier hike of interest rates and high inflation forecast. Just a month ago, the US monetary regulator was not even concerned about galloping prices. And now the chairman of the Fed, Jerome Powell, says inflation might overshoot even Fed forecast at 3.4% this year. A bit of a twist to the overall picture was added by Fed decision to increase the interest rate of reverse repo, tighten requirements on excessive bank reserves, and a revised trajectory of interest rate hikes on top of this. 13 of 18 FOMC members are now seeing a possibility of an interest rate hike in 2023, while a month ago there was no suggestion of it. Such alterations came just after 2 months of rallying inflation, and how the situation might change in a month time when inflation in June jumps to 5.5% or even to 6%. Anyway, the process of tightening the monetary policy has now started. The question is only how fast what is that going to be? And there we may construct an interesting logic when not the inflation is a prime engine of this process but the labor market. High inflation fact is admitted by the Fed, but the labor market is considered by the monetary regulator as being far from target level of employment. And this is the major reason to wait some more before tapering stimulus measures. In this logic, we may consider the healthy is the labor market in the US, the faster monetary stimulus measures would be rolled back and more pain for the market. Alternatively, the worst is a situation in the labor market that would slow down the actions from the Fed and which is better for the market. Luckily, initial jobless claims this week turned to be higher than expected, the first time in the last month. American stock market indices rose a little on this data, and the greenback stepped down after heavily rally of the last day. However, technical picture suggests quite positive perspectives for the S&P 500 broad market index, with a support at 4,200 points and the resistance at 4,310 points. So we may suggest the index would hardly go down any further this week. Crude prices are seen in the upside direction too, as Brent crude prices were trying to close a week above $74.30 per barrel, and even more, above $75.40 per barrel in case of the positive sentiment in the market. Such positive developments may occur if investors would recall of positive downside dynamic in crude reserves in the United States, where they plunged by more than 7.35 million barrels last week. Gold fell into ideal storm after the Fed has changed its attitude towards inflation and stimulus measures early tapering. Yield on US 10 years Treasuries jumped from 1.49 to 1.58, putting gold prices under heavy pressure. Gold prices plunged from 1860 per troy ounce to 1770 within 2 days. So we should better stay away from it for the moment, as interest rates in the debt market would continue to mounting further pressure on the gold prices. The volatility in the FX market has dramatically increased after Fed announcements. The US dollar jumped by almost 2% in one single day. Logically, we may expect the greenback to strengthen further, but we should not exclude strong correction before that. The Euro USD has two simple ways to go: to free fall to the support level of 1.630 or return to 1.1990 or 1.21 levels. GBP USD has the same dilemma too, and will move either to 1.3810 or jump to 1.4080. Well, that's sort of a range trading, and any trading you see in this regard should be made only after breakthrough of near support resistance levels. Last but not the least, USD JPY is trading more comfortably, as it is ranging from 109.50 to 110.60 and would hardly leave this range today. So guys, thank you very much for listening, and I will see you guys next week. Have a great weekend ahead. Take care and bye.